Okay, I think we'll get started. Welcome everyone to Minds Money 5 at 5. It's great to have everyone here and have some of you guys sign in early so we can have a conversation, have a chat beforehand. I think we'd love to have that every week. We've got a couple of things to mention. I guess some of you have been on this before, so there is an ability to ask questions in the bottom of the chat room, so you can suggest things there. And a little bit like we did just in the sort of preamble, please feel free to put your hand up and ask a question, and we will unmute you as well. We want it to be interactive. A couple of plugs from our side. We have launched 2 virtual events at the end of June in APAC and one in Europe. That's in the 30th of June and 2nd of July. Both of those have been really well received. And just to tell you a little bit, about what we're looking for, it's pretty simple: mining companies to come and get involved, take meetings and present. Investors who are interested in taking meetings and looking at opportunities, and then partners as well. So groups who would potentially run something like this that Cannings have kindly supported and powered today. So I think that's it really. I'm going to keep it pretty brief this week. I'm going to hand over to Peta Baldwin, State Director of Queensland, and Andrew Rowell, who's Director of Investor Relations at Cannings Purple, who are going to run the session. So over to you guys.
Hi everyone, thanks for joining in. I'm Peta Baldwin. I'd like to welcome our panelists today. We have Ian Parker from Hartleys. Thanks Ian for joining us. Michele Muscillo from Hopgood Ganim. Stephen Biggins from Core Lithium. George Bauk from Northern Minerals. And my colleague Andrew Rowell from Cannings Purple. Andrew and I both specialise in investor relations for the mining and resources sector. So thank you very much to Minds and Money for having us along to this to power this event, as Mike so kindly calls it. Before we get started, we've got a fun little poll to get on with that Lucy's going to launch for us. Is it coming up? Yeah. So the question that we're going to ask you all to get your opinion on is, how long do you expect the COVID-19 situation to have an impact on the markets? We've got some options for you there. So if you can choose your preferred option, and we'll get an idea what everyone thinks. Give it how long do we need to give it, Lucy?
Give it another 5 seconds or so.
Yep. Everyone see the poll? If anyone's got any hassles, shout out. But okay, so we've ended the polling, and I think can everyone see those results? Yep.
Yep.
So interestingly, we all expect this to go on for quite some time. So it's an apt time to have this conversation. So we might get started with our introduction. Raising capital can be a difficult proposition for small to mid-cap companies at the best of times. But add a crisis situation or a global pandemic, and raising capital can become that much more difficult. While there are still deals to be done in this environment, money raised is usually at a significant discount. And for those who are brave enough to test these waters, the benefits of having first mover advantage when the dust clears is what awaits. The format we're planning to follow today is that myself and my colleague Andrew will be throwing questions to our distinguished panelists to get their expert opinions on operating in these very challenging times. Andrew, would you like to kick off the first question, please?
Sure. I might throw the first one across to Michele. We've seen that the ASX and ASIC have come back with some changes on easing restrictions for raising equity. I guess from a legal perspective, how do you view those changes, and do you think they're actually going to be enough in the current market?
Thanks, Andrew. I think they're viewed, certainly from an advisor's point of view, they're positive. I mean, they're certainly a step in the right direction. Are they enough? It's a very difficult question to answer. I mean, most people would be aware of ASX enhancing the 15% pace with capacity out to 25%, with some caveats around ensuring you offer a tail to shareholders under a rights issue or an SPP. I'm happy to go further into that if there are following questions. So that's very helpful. Is it enough? I think that the answer to that is probably dependent upon the company. For a lot of micro cap companies, at face value, 15 to 25% might seem like, almost a double up in terms of the amount of capital you can raise. But of course, if your market cap is under $10 million, as a lot of micro caps are, that's actually not a great deal of money, fundamentally. So the smaller the company you are, I think the more the less it's helping you, if you like. And of course, in those sorts of companies, for at the smaller end of the market, the ability for their own shareholders to put their hands into their own pockets and follow on SPPs or rights issues is difficult. So I think, to summarise, it's a step in the right direction for sure. There are companies that have certainly, in terms of my own client base, have changed their plans, having regard to the ASIC and ASX loosening those requirements, and it's been welcomed. But fundamentally, I don't think anyone or any of the clients are necessarily saying that this has been a game changer in terms of their ability to keep the business, keep companies going along, or certainly not, take advantage of acquisition or other opportunities. There's just not enough headroom in the market currently, and the move at the smaller end of town, a 10% increase in the ability to place really doesn't move the dial, that far.
Okay.
I might ask a question of you, Ian, if that's okay, please. Have you noticed a significant change in investor behaviour lately, particularly in terms of what they're buying and selling during the current pandemic?
Yeah, you have. There's certainly been a push towards the safer stocks, strong balance sheets, gold, healthcare, and avoiding stocks with too much debt. The retail investor is also very conscious of all these issues that are happening, the QBE, the Newcrests, the banks. So it's almost like a lot of major companies, I won't say every major company, but lots of major companies are going to do very dilutive issues. So if they haven't already done an issue, you're sort of waiting for them to do it. And there's a lot of retail people who are just saying, let's get on the register and then wait $30,000 in via a SPP or something. So there's also been a bit of a boost actually in the more speculative end. We've had there's been a couple of, we'll probably cover that a bit later on, but then a couple of really good discoveries and a couple of really good share price moves in the micro cap end. And what that does is bring back some of that hot money that's been around. I mean, it's been a lot more buoyant than I thought it would be. I thought it would really have a bad effect on retail investor behaviour. But I mean, our numbers, and I know my competitors and colleagues around town are the same. The brokerage numbers and the turnover numbers are really quite high. So volatility creates activity, and that's what we're seeing.
Excellent. I'll pose a question to both George and Stephen. I guess we've seen across the board, pretty much the COVID's put a wrecking ball through the economy for a lot of stocks, from the big caps right down to the juniors. I guess just what it's done for your companies in particular, and sort of how you're seeing the market viewpoint right at this point in time. We'll start with George.
Oh, look, I mean, we've had a drop in our share price over the last couple of months since COVID-19's coming in. We've had the impact of having to put our operation into care and maintenance because of the Biosecurity Act that was put into force for the Kimberley. So that made doing business for us fairly difficult in the isolated place that we are, and the fact that we don't have infrastructure on site and the profits on site like a BHP or Rio, if you like. We had the double whammy where our Federal Treasurer came out and knocked back a capital raise we were doing at a premium in this current market that he knocked back on based on our asset being in the national interest of the country, which has then led to us having to find the alternative money at a 70% discount to that capital raise. So I'm not sure if the Federal Treasurer is worse than COVID-19 for us, but it had a significant impact on Northern Minerals in relation to our capital raising. So we've got another, I suppose, dimension to our challenge.
Okay, Stephen?
From Core Lithium's perspective, we're just starting to see a recovery in lithium stocks and outlook for EVs and lithium at the beginning of this year. And then along with COVID, we got our share price got hit, we got smashed, probably down a third of our share price would, as that sort of panic selling came in. We put out an update to our investors to give guidance about sort of the impacts and where there weren't impacts on the key parts of the business. I think that gave the braver investors at that time comfort and a bit of support. But what we've also been able to achieve is full approval for our project from the Northern Territory Government in this environment, and that we've then sort of doubled and probably almost tripled in share price as a result of getting that full approval. So, the market's still there. The market still sees full value. Still sees value where it fundamentally is. Whether it's full value, probably not at this stage. So I'd say there's still a discount in the market on a lot of stocks, but I think there is still a recognition of value there for those companies where it's warranted.
Ian, I'd like to just ask you, based on your experience in the market, do you see any similarities between what we're dealing with at the moment and the global financial crisis in 2008 and 2009?
Yeah, it's really interesting. As you can probably see from the grey hair, I've seen quite a lot of crises and crashes in my time. I think it's my 30th.
I wondered if you might be too young, actually. I was just going to say.
Yeah, right. my 30th year at Hartleys. So I've seen the 87 crash to a certain degree, .com crash. I've seen a gold boom. I've seen a lithium boom. And the GFC was the big one, obviously. This one has been very different because it was so quick. And I've got to say, look, I haven't prepared any spiel on this. This is a little bit off the cuff, this talking, but it was so quick. And it literally went from 1 week, everything was good. And in fact, everything was amazing. If you go back to the 20th of February, we're all looking at each other and going, how good is this market? And why is it sort of ignoring any sort of bad news? And then 2 weeks later, it was bang, what's happening? What you're seeing, so there's a possibility, there's a couple of things that might happen. Obviously, anyone who tells you they know what's going to happen is just, they're either a liar or a fool, as I say. But so nobody knows what's going to happen. But either we're going to recover much quicker than normal, because the GFC really did take a long time. And we've got to remember the GFC was a financial crisis. The companies, there was banks going broke in the GFC. There was the major insurance company in the world, AIG, that was going broke. Okay, so that was a really, really bad situation. No one's quite sure how bad this one's going to be. It's a health crisis. It's created a short-term employment crisis without any shadow of a doubt. But there's still a lot of companies out there making pretty good money and producing things. And I'm a little bit of the view that it might recover a bit quicker than what people think. And the market is sort of telling us that too. Look, I'm a bit surprised. There's a disconnect between the market at the moment and the economy. The economy looks terrible. All the stats that are coming through are terrible. But everybody knows that. They know it's going to be terrible next quarter. The GDP loss will be awful. The employment loss will be awful. Everyone knows that. People are already starting to look what's happening in 6 months' time. So I'm thinking, or maybe I'm hoping, I'm definitely hoping, that it may not turn into a full-blown financial crisis. And really, if it does, well, what are you supposed to do? We'll all go back to the barter economy, won't we? It's and the other thing that we're seeing in WA is not a bad place to be at the moment. We are, as our Premier says, an island within an island, and there's very little doubt that it's going to get back to somewhere near normal in Western Australia quicker than other places. You can just see it, you can sense it. There's everyone. I mean, people are out shaking hands again. It's but it's a really, that's the $1 million question, isn't it? So that's my sort of thoughts on that.
Thanks, Ian. I guess there's been a crisis situation for a number of companies already that have been hit pretty hard, and we saw probably the biggest one that's been the casualty has been Virgin going to administration last week. Question for you, Michele, is this something that we're expecting that over the next 6 months we're going to see a lot more sort of companies heading down that path? And I guess for shareholders and investors here, what should, I guess, they be looking out for as kind of warning signs to be aware of?
Look, I think there's probably no doubt that there's going to be more in the Virgin sort of situation. I mean, our firm has an insolvency team which is busy. I mean, you can take that as an indicator, and colleagues around town in the accounting profession are also busy in the restructuring insolvency team. So there's no doubt that there's, if you were struggling, I think Ian might have made the comment around debt-laden companies. If there are debt-laden companies before the COVID-19 crisis, most certainly those companies would be hurting more now. It's going to be a question of survival and how much banks are able, and not just banks. I probably shouldn't just say banks, because particularly in the mining sector, a lot of the financiers and a lot of the debt doesn't come from banks, certainly not in the small and mid cap area. So those, some of those financiers might be willing to work with the companies, restructure, push out, capitalise or whatever. And provided, Ian's right, and the equity markets are there, they'll be able to raise money and potentially, deeply discounted rights issues, for example, 50% discount or more, pay back some debt and survive. But there'll be a whole bunch, I think, that don't have lenders who are willing to do that. And certainly, in North America, I think there was an announcement overnight of, one of the lenders over there sort of pulling the pin on a mining entity. So that there are lenders out there that probably don't have either the balance sheet or the will to want to work with mining companies, and the result of that's going to be, more Virgin type administration processes. In terms of what to look out for, well, the key there is debt. Not a lot of good companies go into administration for fun. A lot of good companies with a lot of debt go into administration. So that's obviously a key factor for, as an investor to have a look at. But yeah, beyond that, it's hard to know, because we are actually pretty early in the cycle. I mean, we're a long way into the, working from home and social isolation, but we're not very far into the how what sort of impact this is going to have on businesses. I think that's going to come probably in the next quarter, and we may see more, based on what I'm hearing. We may see more of those receiverships, administrations, and the like coming out.
Okay.
Ian, did you have any comment around that as well?
Well, yeah, Virgin was a struggling company before the virus. I mean, Virgin owed $5 billion. It hasn't made any money. I think it's made money 2 years out of the last 10. So their business model was basically flawed. And I think you're going to see there's quite a number of other companies, their business model is flawed. What this has done in some ways is actually showed up companies that were probably, doomed to fail at some stage in the future. This has just accelerated the process a little bit. I mean, that probably sounds a little bit harsh for their employees, but I mean, if you owe $5 billion and you don't make any money, how is that a valid business model? So it was something bad was going to happen at some stage. This has accelerated it. And it's the same with some of the miners. You're seeing that there's been a number of the miners, the nickel mine, Panoramic, and these guys have shut down their mines. They were crappy mines anyway. They were losing money before the crisis, before this, the virus. So if people were losing money, already indebted before the crisis, this has accelerated it. So, yeah, I think the Virgin was a very high profile one, and everyone says, isn't it terrible? Well, it's terrible that directors borrowed $5 billion and never made any money. Not that the thing went into administration.
Yeah.
So, yeah, that's my thoughts on it. But I agree with the other speaker. Yeah.
Yeah.
Okay. Thanks,
Okay.
Ian. I'll throw once again for the company speakers for Stephen and George, and I'll start with Stephen. When I guess most companies have been on the hunt and lookout for new equity over the last couple of months. It seems to be a pretty sort of popular route at the moment. Have you noticed sort of any major differences in the discussions with brokers or investors in regards to discounts, fees, approaches, commitments, those kind of things?
I think there's been a sort of an interest in themes in the equity side in the resources space. I think our approach has been to sort of keep a set of alternatives, so have a diversified source of capital for the company, along with the obvious source of equity. Over the last 12 months, we've also brought in non-dilutive finance through royalties with the group in Canada. We've got close relationships as part of the lithium business with a number of downstream customers into the lithium and into the automotive industry. So those strategics are there, although there's a little bit more ambiguity about how, and George mentioned about how FIRB is going to approach investment, particularly from China. But alternative to that is that I think the Treasurer is also looking to encourage and facilitate further investment and strategic investment from all other sources around the globe. Particularly on equities, I think that there's certainly the beginning of this year. There's a lot of discussion about sort of opportunities to get in, and from my perspective as an investor, looking at good stocks that got smashed up through the GFC with great opportunities to get access to them on the other side, and I think there's some of that thinking going on now. Maybe that explains some of the activity that Ian was talking about, is that there is some great buying opportunities, so some opportunities to get in some real undervalued stocks right now and on the way out.
Okay, George?
I look from a slightly different angle. In some parts of the market was broken. It was a real struggle for a lot of the micro caps to try to sort of gain interest on the market, if you like, and that was late last year, early this year, if you like. I probably agree with Ian's comment. We're probably seeing better liquidity in the market than we were expecting, and liquidity obviously does encourage and induce people into investing, if you like. We've seen reasonable levels of liquidity in recent times, if you like. It's going to be interesting to watch how the FIRB guidelines are managed in the country. I think AVZ was a really surprised announcement last week, where we saw a Chinese investment into an African asset be stopped by the Treasurer, with the product likely not to come through Australian shores. So that probably surprises a lot of people, thinking, what's the constraints? I mean, Northern Minerals is an Australian, domiciled asset, so different view, if you like. It's a critical mineral. So we just got to be a bit cautious about the whole thematic about, China, or looking at either particular countries, about who we like, who we don't like, if you like. In the rare earth space, there's a long process to get a diversity of supply chain, if you like. So it's important to work with China as we diversify away from them. No different to lithium. Lithium's got similar challenges in relation to supply chain. So I think we've got to stand back and understand what we need, and have a bit of a longer time horizon than just maybe the next 3 months, 6 months, 12 months.
And that's a challenge, George, because currently in the lithium space, for hard rock lithium, China is the physical customer for product coming out of Australia. So you're not going to close that level of trade. But I think there's certainly concern at federal level, with about sort of expanding and diversifying the sort of the supply chains, and sort of things that you're aware of as well.
Actually, I'll just jump in there. Sorry, Peter, as a bit of a follow up there from Michele. as to effectively on FIRB, do you think that, I mean, they've pushed out their timeframes and they've brought down the sort of the thresholds for assessing it. Where do you think kind of where the money will come through, whether we'll see a sort of flood of money looking to buy up cheap assets here, or whether it will be viewed through a particular coloured lens from where the money's coming from?
Yeah, it's an interesting one. I mean, I think that the government's thinking on this is pre-COVID-19, it was a level playing field. You know, various countries were ticking along at their own particular GDPs, levels of investment. My sense of this, and this is probably not answering 100%, you know, on your question, but my thinking is that what the government's done here in terms of lowering the shades, if you like, on foreign investment is a bit of a hedge on what happens if Australia's recovery isn't as fast as, say, China or the US or Europe, for example. If we've slowed the curve to such a degree that we're still talking, you know, about COVID-19 in, you know, 2021, we need to, you know, ensure that we haven't saved a great number of lives, but also have had, you know, other economies back on their feet well faster. So I'm not certain that the government's view on, you know, dropping the FIRB thresholds and kicking out timeframes was directed to any country in particular. You think
it was more just think it was more just a sort of anti-pilfering type measure to stop raiders coming in?
I think so, and I think on that, if you look at it through that lens, it was probably a good idea. But obviously, you know, we have one close neighbour who's very inquisitive, so disproportionately a number of Chinese investments are going to get sort of squashed, and therefore, you know, it'll be seen as an anti-China measure. But I can understand the rationale for wanting to stop everyone, you know, coming in until there's a level playing field, you know, back on the horizon.
But you know, we need to remember we've always been a country that's asset rich and cash poor, and you know, we're always going offshore to look for funding. I think we just need to be, you know, thoughtful about the whole process, because who is Australian? I mean, you know, you look at a lot of our companies and you've got to ask yourself, you know, what's the definition of Australian and keeping Australian interest and all the rest of it. So I just think we've got to be mindful that we're not, you know, we're not going to regret the situation. You know, I'm fully supportive of having alternative supply chains, but they're very complicated things to change and move. And, you know, rare earths, lithium, some of these critical minerals, they're big, long investments downstream. We've only got one part in Australia. You know, we're a quarry. We're very good at the front end, if you like, but we've got to work together across the whole supply chain to make sure that we get to the end product and we have diversity. China's done a great job in controlling all of those, but we've got to have a lot of people come along for the ride and do some heavy lifting. Australian government's offered up a $4.5 billion access to a defence fund. We've got to make sure that money gets allocated. You know, NAIF's there for great opportunities for the northern part of Australia. It's got to be allocated and used. So there's a lot of pools of money. You know, one of the criticisms I have is we have a lot of bankers in charge of non-traditional banking money. So they look at it and go, oh, that's not, you know, you can't apply the traditional matrix to give some of that NAIF money away. Well, we'd go to a normal bank if we could. So, you know, there's a whole host of things. The Australian government, you know, and I know it's going to be tougher now. We've just released 130 billion and many other measures to keep the economy going. It's a tough ask, but we've also got to stimulate the economy. And if we want to do it in the critical mineral space, like with Stephen and myself in these areas, we've got to make sure that they're coming along for the ride.
Yeah. I've got a question that I'd like to pose to all of our panelists, just in general. I mean, leading in from the last discussion, I mean, traditionally, in order to get funding, you guys would be out on the road, you know, for a week or 2 weeks at a time. You'd be traipsing up and down Collins Street. But the challenges of what we're dealing with at the moment have meant that we've had to come up with different ways of getting in front of people. We've noticed that in our consultancy that we are actually running a lot more virtual meetings and webinars for our clients, getting people in front of people is different to what it used to be. And some of the feedback we've had is that some of our friends and clients have found that they can do 30 meetings over 2 days from the comfort of their own living room, rather than having to spend a week or 2 weeks on the road. I would just like to get a comment from all of you as to what your experience is with sort of dealing with this new normal, and whether you think it might signal the death of the traditional roadshow. We start with you, Stephen.
Yeah, sure. I enjoy the traditional roadshows from time to time. It's a certain level of stamina involved in
Yes.
maintaining that enthusiasm when you're doing it for weeks. But I agree. It's a great opportunity to be able to sort of build relationships and maintain relationships without that level of travel, and be able to sort of do that a little bit more consistently. I think for smaller companies that don't have the sort of the resources, if you like, to send teams of people off around the globe, it probably is of benefit to be able to sort of use more sort of cost-effective and time-effective ways of communication. And it'll be interesting, to see how we haven't sort of directly sort of tested that ourselves, but to see how the investing side of the world now starts to make its decisions, because traditionally, there needed to be, that sort of FaceTime a number of times with those people making the decisions, to build that sort of eyeball who they're investing in and that level of trust. But if those that are in those investment decisions, those investors, they're not going to stop business. They're not going to stop their business now. So I think they're going to have to start to be able to make judgments and build relationships and levels of trust using the telecommunications tools we've got.
Michele, did you have any thoughts around that?
Yeah, I mean, there's no doubt that it has a role. I mean, in my practice, we're using it, the virtual sort of meetings very effectively. But in terms of the marketing side of things, which, I guess to some degree I'm involved in, there's definitely a role for it. But there's also a limitation to this sort of forum. You can't have the social chat, the bumping into, people that you've seen 10 years ago in the corridors, or walking from one meeting to the other. So I think there has to be a balance between the two. I think the efficiency of these sorts of meetings is fantastic, but there has to be room for both. Interestingly, I'll share an observation, not necessarily related to capital raising, but part of my practice is also on the M&A side, and of course with COVID-19 travel restrictions, it's impossible to undertake a mine tour. The usual sort of fly in, walk around, look at the mill, look underground. So it's been interesting to see virtual mine tours becoming a thing. That's I guess jury's still out of whether that's an effective way to do it, but we are making do, that's for sure.
Can I ask, is there anyone of the audience that has conducted any of these virtual site tours and seen a success or them working or not working?
Verify are a big one, aren't they? In North America, they've got a very interesting proposition. I don't know if anybody's used Verify, but
Okay.
No, we've done a lot.
Maybe just Peter, just to add one thing, because I think it's quite relevant to us, to Minds Money and IMARC as an events company. Certainly for us, we find it's a challenging time. Everybody's looking at different models, and lots of people are filling this space. What we have found it's interesting as an observation is actually the hardest part of normally putting a traditional event together is not to get the mining companies in a good market. They want to go out, they want to promote, they want to go to places like Hong Kong and London. It's, as Stephen said, it's a fun place to go, and they see that as part of the trip and that opportunity then to extend those conversations. What we find actually interesting is there is an appetite for investors, and that's generally the hardest part for us as a traditional event organizer, to actually get the amount of investors engaged in it, not just coming as a key fund manager to speak, but also saying, okay, I'll bring my analyst or I'll bring my portfolio manager to do meetings. So we have a layered approach. Now, in our recent conversations, they've been really positive, I think, because they can see there's there's opportunities to buy people at a lower price, to be blunt, and they are looking at opportunities. So I think it's that's an interesting observation, that investors are still definitely looking at projects and new ways to interact.
Ian, you were making a comment?
Yeah, well, we're finding the virtual roadshows very efficient, actually. I think our Insto guys have done about 20 of them in the last month or so. It's very efficient for both the brokers and the companies, because you can get to talk to more people more efficiently, and you just get a better turn up. I mean, even our morning meetings. So we have all our analysts. We have 7 analysts at Hartleys. They run a morning meeting every morning, 8:30 or 7:30 in summer, and it's a really good quality meeting. But we get about 5 dealers turn up to that maybe. Well, we're doing that online, phone in. We get 25. Everybody. It's just a much easier. Everyone's saying it's an easier way to listen. You can do other things. You don't have to be completely engaged. But then I would say that for key things, for key meetings, for mergers and acquisitions, or if you really need to know a company, there's no substitute for face-to-face, really. You've got to actually, because when you're online, you don't know, is the person really listening to you? What's getting through, what's not getting through. You miss all the sort of the
social cues.
Non-verbal, the non-verbal interactions, which are important. You want to, if you're about to give someone a whole heap of money, you want to sort of see the whites of their eyes, look them in the eye, and say, are you going to use this money efficiently? And you can't do that online. But I tell you what, for roadshows and stuff, it's so much cheaper as well. Like we would have had people on the road flying around the country. We would have had 2 or 3 people all the time. Often we're paying, sometimes the companies pay. So yeah, it's much, much cheaper and more efficient. And so far, the business hasn't suffered dramatically.
We've had some quite funny feedback about the fact that for online roadshows, everyone's always on time. There's no, which is good to have. Yeah.
Peter and Andrew, we have some questions from the audience if they can ask them at this point. I think Marcus Lake had, or maybe it was a comment from Marcus and a question from Headley as well, if they're okay to ask something. Marcus?
Sure.
I'm off mute. Okay. I just think there's nothing beats face-to-face when you're selling something, especially nothing beats the face-to-face. The contact you have with people, to look in their eyes, nothing beats it, just a comment.
Agree.
Yeah.
Headley?
I have a question, but I might preface it with a comment. And I think this whole online face-to-face thing is interesting, because you've said nothing beats face-to-face. I agree with that entirely, because you can get all the social cues, but there's no other way that you can see a person's real personality when they turn up wearing a shirt and tie because they're raising money. So, Andrew, you've given the game away tonight.
Yeah. I've got shorts on, but anyway.
Whereas, at the moment, you're seeing into my study, you're seeing what sorts of paintings some people have got on the wall inside their house. You're seeing real access to their personality. J.F. Burtoncourt lives underneath the Sydney Harbour Bridge, so go figure. There's not much more real that you can sort of get to a person's personality, which can be a lot to do with dealing with them. So I think that's interesting. But no, I have a question, and maybe it's for Ian. But pass it around the panel if you feel fit. You've talked about investor interest, and I'm just curious. I mean, we went into COVID-19 with a fair bit of, I think, bubbling M&A interest in the market. Companies looking to grow, particularly in the gold space, but there was ambitions being flagged across the market in different sectors. Notwithstanding the physical barrier to doing site visits and things like that, I just wonder if this fall in values, in your opinion, might have brought forward any opportunistic interest of some of the larger miners to either hoover up juniors, looking at juniors, or to put 1 and 1 together to make 3 or 4 in the larger part of the mining space.
Oh, look, I think absolutely. That people have worked out again that in these times the strong get stronger and the weak just don't survive. And you're already seeing it. Newcrest is buying that thing in Ecuador from today. One of the ones we follow closely, West African Resources. West Africans bought another gold mine in Burkina Faso for $45 million US. I think there's just going to be a plethora of these deals done. You know, the companies, because there's actually plenty of money around, particularly for gold. And if you've got a strong management team, or like the West African one was a stranded asset. It was a nice asset, but it's stranded. They're never going to be able to do anything with it unless they built their own plant. So suddenly it's made everybody, I think it's revalued things a little bit. As you know, Hedley, better than me, people often have an inflated view of what their company's worth or what their asset is worth. You know, I mean, you talk to them in a bull market and they just go, oh, I'd never sell for that. You know, it's worth much more. What this has done is made a whole lot of people wake up to the fact that, you know what, your mine or your company or your asset is not worth what you thought it was worth. You can't get that multiple anymore, and you may never get that multiple. So why don't you take this cash that we've got and get something for it? You know, because that's one of the only good thing about these sort of times. It does focus people's minds on real value, rather than sort of what I would call bullshit value, you know, that, so yeah, I think there's going to be it will just a flood of these mergers and acquisitions. I really do. I hope we can participate.
I can probably add to that. I think that's 100% right, Ian. And I think that, that if you have cash, you're going to be in the driver's seat, because the flip side of what you're saying, which is what I've seen, you know, in the GFC and to some degree now, is during the boom times, you know, asset values are skyrocketing, and people try to, you know, it's hard to find, you know, a justification to pay that much for an asset. In downtimes like now, asset values are cheap, but the flip side is the companies say, well, I can't pay with shares because my share price is also taking an equal hammering. So the companies with cash are the ones that are really well placed at the moment to pick up assets cheap, because the value of a dollar is the same yesterday as it was today fundamentally. And they're the companies like Newcrest, like others around at the moment, digging around for good assets. And you know, shareholders, I think, are going to be happy to take a dollar rather than a share in a company that's, you know, extremely devalued right at the moment.
Yep.
Yep.
Yeah, certainly when share valuations get smashed up, I mean, from our perspective, we got smashed share price wise during the COVID panic, and you know, only for a day or two, you know, the company was valued at probably a tenth of what we think our revenues will be from the project. But you know, it's good to see that we've bounced back to a level of you know, recovered in share price substantially since then. But yes, yeah, that theme started to sort of run through the back of your mind that didn't exist prior to that, in regards to being a target because of what the market's done for valuations.
George?
No, I'm all good.
Yep. I guess just a follow-on from that question then, as to whether or not we're going to see different parts of the world recover at different speeds and different economies recover, which will give, I guess, some economies a bit of a first mover advantage, that their money or their share price or their shares will be worth more when it comes to those sort of corporate opportunities and rates coming in.
Well,
The answer to that one to Donald Trump. He's got a view on the matter, I think.
Yeah.
Yeah, I'm not clever enough to pick what's happening in overseas things. I mean, if you can talk positive or negative, really. If you look at the US, look at that oil and gas sector they've got there. There's hundreds of billions of dollars that have been lent to all those fracking companies in the US, none of which are making money at the current price, and there's a massive oil glut. Now, what is going to happen when next year a lot of those bonds and a lot of that $100 billion is supposed to get repaid by those companies that aren't making any money? You're drawing a line through, you're hoping the government is just going to put a whole lot of money in, or there's going to be some major bankruptcies in that oil and gas sector. So yeah, we try and be positive, but you've got to be very cautious as well, because there's a lot of pretty bad things happening in that economy. And it's all around debt. You know, if you have a lot of debt, you want to be trying to pay it back pretty quick, I reckon. It's because you don't want to think too carefully or too closely about what might happen if these commodity prices, or particularly oil, if oil stays where it is, if that stays at $20 a barrel, are you going to get major social unrest? The whole virus thing is just a silly thing. I mean, do we really think there's 2,000 cases in Indonesia, for God's sake? There's hundreds of millions of people there. They reckon they've got 2,000 cases. You know, India's got 6,000 cases. Really? There's 1.2 billion people there. So this whole thing of reporting how many virus cases there are and we're going to recover quicker, it's just, I personally think it's just a media beater. You know, that there's the stuff I read reckons there's 10 times the number of virus cases is what gets reported. 10 times. So this thing, it will be with us for a fair bit longer, but I think the world is resourceful enough to cope with it. You know, they will cope with it. You can't just leave things in lockdown. Otherwise, slowly the economies of the world just grind to a halt. But look, we wouldn't know. We wouldn't know what's happening in other countries. We're relying on news, fake news that we can't really tell. Well, it is fake news, you know.
Yeah.
One of the interesting things that was spoken about probably about a month ago was things about people having to take stock about diversity of supply chains, making sure that now that we've had this pandemic that it did bring the world to a halt. Do we stop and have a look at our reliance on one country or one supply chain? There was a number of conversations about, is cheap best? It's going to be interesting to see how people respond to that. I think from is the cheapest the best is going to be hard to run away from, because I think it's just built in our DNA that we do always have a look to the cost efficiency or cheapest and the like. So that's going to be an interesting one. And I know from a critical minerals perspective, it was a hot topic in November last year when the Australian government announced a critical minerals facilitation office and announced the access to $4.5 billion defence fund. And a lot of that was around the whole trying to get away from the reliance on China. Is that going to be a theme that we will see carry on for this year and beyond, that people are now fearful and have seen in a real life scenario how dependent we are of some parts of the world when we've seen the shutdown of borders? That's going to be really interesting, because if it is, then how do we make those supply chains diversify from China? How do we start unpacking the last 20 years?
That's a really good point.
Yep.
And we've given a similar message to the feds, George, about that there needs to be that sort of complementary sort of strategy around sort of domestic finance for projects if there's going to be sort of more refined view on where that finance comes from geographically overseas.
Yeah.
So, talking geographically, I mean, we've got both of our panelists have got projects in Australia, which Australia is generally doing reasonably well, but each state is slightly different. And I think Stephen was talking about NT government today announcing its sort of way back plan ahead of others. Probably a question for Ian. Do you think, and we've got some other company reps on here from that have got projects in other parts of the world. Do you think geography will have a reasonably big impact on, I guess, share price recoveries going forward, where for the junior miners, depending where their projects are, how quickly they can get back on the ground and actually commence work and sort of resume from lockdowns, whether that'll have an impact on their prospects and share prices?
It's a really good question, Andrew. I've been surprised that there hasn't been more of a discount given to some of these countries where we really don't know what's happening. Africa's the big one for companies that a lot of the companies we follow have projects in Africa. I personally haven't been to these projects. Some of our analysts have. They're in countries where we just cannot possibly know what is happening. So my personal view is there should be a higher risk profile, a significantly higher risk profile put on those projects by investors. That hasn't really been the case necessarily. We've seen some of these projects, the Perseuses, the Tietos, the stocks we follow, the WAFs, the PDI. I mean, PDI has got a project in Guinea. They found some things, everyone loved it. The stock went up tenfold. So it should impact, but it doesn't seem to be at the moment. There is an African discount, but my personal view is the discount's not enough. But investors seem to want to lap these projects up. You know, the other jurisdictions, you know, US, I mean, South Africa, I personally think is really difficult. US, hard. Europe, you just can't. No, there should be discounts on them. It's got to be easier to do business in Australia, but at the moment, there seems to be quite good money for lots of things, you know, in all sorts of weird and wonderful places.
There is
Andrew, maybe just going to jump in there. We've got Peter, who's got obviously a project in Burkina Faso, and Andrew Stewart. So if we could maybe ask just for their input, their experiences from what Ian's just commented on. So maybe Peter first.
I should say that our primary project is in Côte d'Ivoire, and that's what our investors are asking us, our shareholders. Can you be drilling right now? And yes, we can. You know, our drill company has a base within Côte d'Ivoire. Abidjan itself is kind of locked down, except you can't come in and go out except for essential services. But the rest of the country, you can operate. And like everywhere else, you know, the numbers reported of COVID, I'm very skeptical. You know, it depends how much testing you do, and for, you know, a lot of places when you test for COVID, it's, you know, people die in hospital of COVID, and how about all the people that are dying at home, like in India, for example. So, you know, just talking to our crew, you know, who've been there for, you know, we've known them for 10 years. We personally don't need to go over there to start those programs. So we can actually remote control them. We like to go over about 3 times a year or something, but you know, I don't see it as an impediment.
Yeah,
And Andrew?
Yeah, I'd echo Peter's comments. Mongolia, where we're operating, shut its borders in early January. Mongolia's seen 30 cases of COVID. All of them come in on the plane and quarantined at the airport. There hasn't been any spread internally, and we're operating on the ground like we normally would. So, you know, I think when you look outside Australia, everywhere's different. But for us operating on the ground, I'm glad we're operating in Mongolia, because we haven't been able to halt things. We've been able to travel between regions. It hasn't really slowed our program down. And I think as an industry, it's quite interesting at the moment. Exploration results are being rewarded. And so, you know, it's a time to get ready for us to rebound out of this crisis.
Yeah, I think.
You were going to say, yeah.
Yeah, I was just going to make the point that you need to make a distinction between, you know, a jurisdiction that might have an issue and a mining company in that jurisdiction. For example, I've been to Andy's project in the middle of the South Gobi Desert. If there's anywhere you want to be right now to avoid COVID-19, it's right there. You are not catching it at Andy's site in the middle of nowhere. And that's the point. Even, for example, I sit on the board of a producer in New South Wales. New South Wales is the hot spot, you know, state for COVID-19 in Australia, but where that project is in the middle of, you know, northwestern New South Wales, there's nothing, you know, there's a small town nearby, but there's no cases of COVID-19. So you have to sort of divorce the country and maybe the jurisdiction from a project, which by definition are generally in the middle of nowhere. And so you're unlikely to be directly impacted by the virus. Where the impact is probably going to come, and Andy might want to talk to this, is in terms of if you've got a project like OT or you know, development project, it's not the virus itself, but the fact you can't get you know, mills delivered or whatever it is delivered because supply chains have basically come to a grinding halt.
Thanks, Michele. I understand that we're almost out of time. So I just had one closing question, and any of our panelists are welcome to comment on this. But one of the things, Ian in particular, we wanted to pose to you as a closing question is, you know, is there still money out there in this environment, despite the fact that it could be associated with some fairly heavy discounts for companies that are looking to do a raise?
That's a categoric yes. You know, it is very company and project specific. There's always money for good companies. It is probably at a discount. I mean, it's actually quite a good time for brokers because we're needed again. You know, when everything's booming, nobody actually needs us. They can go and do it on their own, but they sort of need us again now, so it's quite nice. It'll sound like a biased comment, but we're sort of saying that it's better to go early rather than later because there's only going to be a certain amount of money out there, obviously. But yeah, there's deals happening. I mean, we're not participating in them all, but there's deals happening left, right, and centre at the moment. And there's plenty of money. There's always been quite a lot of liquidity. A lot of the big funds, a lot of the private equity funds and things were sitting on the cash because they thought things were overvalued. Well, all those fund managers and private equity people, they don't get paid for sitting on cash. They get paid for doing deals. So look at the appetite for the big raisings they've had. I mean, they just get, Newcrest gets $1.5 billion underwritten in 24 hours type thing. And little companies are getting money as well, you know. And so, yes, there's the category, yes, there's always money for good companies. And some of the success that's happened, as one of the guys said earlier, that you're getting rewarded for exploration success. There's half a dozen of these small, they used to be microcaps, they're not microcaps anymore, the De Greys, the Legends, the Chalices and stuff that have made really good discoveries. And boy, have they been rewarded, you know. So the hot money, the investor, the punter's money is really looking at this sector as well. You know, they want the next, they don't want to get 1% sitting in the bank. They want the next winner and they're prepared to take a risk, I believe. So yeah, I reckon it's, look, we have to be optimistic. I have to be optimistic, otherwise I give up. But it's not as bad as what, you know, some people reckon.
Yep. I know that we're almost out of time, Mike, but did any of our other panelists want to comment on that, on your views as to whether there's, you know, whether this is a good time to look at raising?
I think there's challenges at the moment in raising capital, but as Ian said, if you've got a strong value statement in a sector that's sort of recognised as sort of being one of the themes that's about where we are now or about where the economy's going, then there's that level of interest. But yeah, probably Ian's closer to the sort of the pulse of sort of where that's going.
Thanks, Stephen. Sharina,
thanks.
Sorry, Mike. Yep.
I think we're there. We've got 1 minute left, so I'll make it less than a minute. We'll be sending a link round to everybody who contributed today and spoke, and thank you very much to everybody. It's a very interactive session, so we'll send around a link. Please share that with your groups. We'll certainly be doing that. The next session in APAC is in 2 weeks' time, so the next session is in the UK, 5 p.m. London time for the European market. So I think that's it, really. A final thank you to everybody for being involved, and hopefully we'll see you in the next session in APAC.
Yeah. Thank you to the Melbourne Mining Club,
Thank
the
you,
guys
Peter.
at Cannings.
Thank you.
Thank you.
Thanks, Richard, and thanks to
Shireen,
Stephen,
you just
Michele,
saved me there.
George and Ian. Thank you very much. It was a great session, and thanks for everyone who
Thanks for everyone involved in organising.
Oh, thumbs up
worries.
from Simon there. Thanks, Simon.
Hi then.
Thanks, Simon.
Thank you.
Oh, Headley's clapping. Excellent.
Headley, thank you.
Thanks, Brad. See you next